Good morning. Friday's finally here, huh? A few people have asked me if out of things going on in the market, if I'm going to have anything to say about it. So my apologies. Things have been a little busy here. So I do have some stuff I wanted to share with you all. I'll try and keep it under 3 minutes. Really talk about the incredible reset of Fed expectations, and also talk about the premiums that are out there, or more specifically, the lack thereof, out in the market today. So the biggest thing that's happened, obviously, from a Fed standpoint, is you take a look at the start of this year, and everything about the Fed had been about calmness. Don't worry, we're not going to do anything too fast. We're going to just maybe start talking about even the tapering thing. And so the market had this expectations really not very long at all ago that we're going to have a quarter every other meeting. Then suddenly it's, gosh, could there be a quarter every meeting? And suddenly we got to the point 5 weeks ago when the Ukraine war started, the market actually, the 10-year reversing, going down all the way to $1.75, where the market kind of thought, you know what, gosh, the Fed was expected to tighten. With everything going on here, I think they might have to actually hold. This is going to go ahead and tighten economic growth quite a bit. Market quickly realized that the Fed is not on board with that. It didn't matter what was going to happen with economic growth. The Fed realized they were very far behind the curve. Fed credibility, really, frankly, 40 years of Fed inflation fighting credibility was on the line, and the Fed was going to act. They were going to act strong, and it wasn't really going to matter what this was expected to do to U.S. or even world GDP levels. So you have happened what we've had happen now since March 2nd. It's a total reset of Fed expectations, and you've kind of seen the Fed governors literally have a contest among each other about who can be the most hawkish. Somebody comes out and says, we should hike 200 basis points. Somebody else comes out and says, we should go 250. Somebody else says, screw that, that's not nearly enough. We want 300. It's like some sort of auction for how much are we going to hike and how fast is it going to be. And we can all see the results of that. The 5-year yield, which mortgages, 10-year treasuries is used as our benchmark, but mortgages have a tendency to last 5 years more than 10 years. So the 5-year part of the curve is really going to have a bigger effect on mortgages. That 5-year yield has gone from $1.55 to 275, 120 basis point increase in only about 5 weeks. It's a huge move. People are equating it a little bit with the taper of 2013. I don't think so. The taper of 2013 was something that, from a Fed standpoint, didn't really even manifest itself. I think this is really the better parallels are drawn with 2003, and really even better, which was just after I started the mortgage business in 1994, where you had a period of extremely low Fed funds rates, and the market was now making a quick adjustment to a tightening cycle that was going to be underway. In 1994, we actually went from mortgage rates anyway, from 7.25% to 9.75% in a span of only 8 months. It was a severe butt whooping for the bond market. What we've had here, actually 175 basis points, almost that full amount in rates, and that's been only since January 1st. So to a number of degrees, this action has actually been more violent and more severe than what we had and what we thought was kind of the mother of all bond bear markets, which was in 1994. The other part of this we have, which is going on right now, especially in the last several weeks, maybe the last month or so, is a collapse in premiums that are being paid out there in the market. On a scale of 1 to 10, my understanding from a compliance standpoint about bona fide discount points is probably a 2 or 2.5. But obviously, everybody's struggling right now with the amount of premium available. We're especially struggling with it on the Ginnie side of things. There's a lot of folks who have interest in something in the mid-5s in terms of a note rate. That takes a Ginnie Mae 5 coupon security. 5 coupon securities can put in anywhere between 5.25 and 5.75 into them. We've got a problem right now in the market in that they don't really exist very well. If you look at TradeWeb, where a lot of these things in theory are going to be trading at, right now the bid on a Ginnie 5 on the screens is 99.28 plus for a Ginnie 5. The offer, what could you buy it back for? 103.17 plus. Not a 3-tick bid-ask spread, mind you, a 3-point bid-ask spread. Bottom line, there's no market for it. Right now, we actually see where probably 17 out of the top 20 lenders in the country, where all of their specified pools, in addition to their regular Fannie, Freddie, and Ginnie pools trade. There was some traded by a pretty good-sized correspondent 2 days ago that went for 10 ticks above Ginnie 4.5. Literally, for an entire half coupon, half in yield, they got 10 ticks out of it. There was another dealer that's big in the Ginnie Mae space that yesterday came out and told everybody, hey, we're axed to buy Ginnie 5s. Axed meaning we've got strong demand to buy them. and they gave indications of what they could pay. It was a whopping 12 ticks above Ginny 4.5s. So it doesn't do you any good really right now, even if you could offer fives in a good liquid market, to have something that doesn't even pay you a 1-to-1 multiple for the increased interest rate. Now, the reason for that isn't because Ginny fives are worthless. It's because this market has moved so fast that nobody knows what the heck they should be worth. Not just the fact that we have a possible MIP cut that's over our heads that could happen, but in terms of Ginny fives, we haven't really originated any as originators in 3 years. And in the meantime, we've refinanced 90 to 95% of the universe of Ginny fives that are out there. So there's not a heck of a lot out there. We should be pricing to them, but there are hardly any trading or being made right now. So the bottom line is nobody from a dealer or an end investor, by end investor, I mean buyer of these securities, retirement funds, pension funds, municipalities, they're not sure what in the heck they should be worth. So it's hard to price to them. We're in this no man's land on a lot of those premiums, which obviously causes big problems with being able to charge bona fide discount points to borrowers. This is something that's going to get better. What we need calm in the marketplace. A Ginny 5 should be, frankly, worth at least a point more than a Ginny 4.5. Right now, nobody knows what the heck it should be worth. So what can we do about it? Right now, frankly, not much. We're in the middle of a pretty nasty storm. It's kind of like a Cat 5 hurricane in Bondland. I've actually personally been through the eye wall of a Cat 5 hurricane when I lived in St. Thomas. And really all you can do is make sure all those windows are shuttered, stay calm, be disciplined, and be patient. Have a good weekend, everybody.